officially live on Facebook for the Not Your Average Investor Show. Today we're talking about what's happening in cash flows in this economy, what's happening in the investing market. I've got the shaky head today. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because of his genius concepts, generates cash. He's a great co-host. His name's Gregg Cohen, and he giggles constantly. Say hello, Gregg Cohen.
Hello, everybody. Great to be with you.
And in the chat, hanging out with us on screen for a little while longer, the magnificent Madison, our community manager. Say hello, Madison.
Hello, everybody.
And it is great to be here. I love everybody starting to check in right now in the chat, getting ready for my favorite moment of the day on Tuesdays. But if you are listening on the podcast, you're watching us on YouTube, you're seeing this amazing things happening. What you're missing is the interaction, the community, what's going on in the chat. If you join us live on a Tuesday or a Thursday at 12:30 Eastern, you're going to have a lot more fun. So go to nyais.com, pop it on your calendar, and just show up whenever you can and be part of the what?
Roll call.
Bring it, roll call. All right, here we go. Madison already checking in here saying, welcome to the Not Your Average Investor Show. We got Lee Bishop, the MVP of the community, saying good afternoon, everyone. We got our leadoff hitter, John Henning, saying good afternoon, all. We got the ringmaster, Drew Barnhill, saying good afternoon, all. We got Dean Curry from Columbus, Ohio, saying good afternoon, everyone. We got the man that everybody knows, Noah Randari, saying hello, everyone from California. We got Marilyn Cotterman from Homosassa, Florida.
It's the home of the manatees.
It's the home of the manatees. We got Chris Gonzaga from the illustrious Hudson Valley, New York. Good to have you, Chris. Good to have you back. We got the fairy godmother of the Not Your Average Investor Show community, Jen Filzen. Greetings from the lovely Monterey, California. She just had a epic meetup up in the
fresh off the Monterey chapter of the Not Your Average Investor Show community.
That NorCal chapter, boy.
It's a strong one.
Woo.
Seven standard.
It is excellent. We also happen to have the first family of the Not Your Average Investor Show community, the patriarch, Ken, the matriarch, Carolyn Meline. We salute you. We got Joanna Batista hanging in from the Philippines. Good to have you with us, Joanna. Who else we got? We got Eddie Harris from Hotlanta checking in. Good to have you back, Eddie. Who else we got in here? We got Raj Bantu. Raj, good to have you, buddy. He was my roommate on the bus for the IRL meetup. Raj, good to have you here, sitting alongside me once again. Anybody else? We got Nadeem Shah with his characteristic good morning, good afternoon, everyone from the West Coast. Nadeem, happy to have you. I said we kick these things off, GC, because I already dilly-dallied with the technology issue long enough. What's happening with cash flows, man? tell me what's going on.
I wish we could go back and replay like past episodes. I wish we should have thought about that. We should have done like past episodes like a year and a half ago, and then 17 months ago, 16 months ago, 15 months ago, right? Mm-hmm. We would have shown that on our show here as a part of this community, we would have talked about this phenomenon with cash flows, which is that cash flows are going to go down for future properties that you purchase. Mm-hmm. And the reason that is happening is because home prices have gone up. Interest rates have gone up. We knew that was going to happen. And although rent rates have also gone up at a rate that is faster and higher than the norm, they have not kept up. And this isn't a new phenomenon. This happens most market cycles anyway. So we knew this was going to happen. This is what we have talked about. But if you look today on the property that you're purchasing for a turnkey rental property and look at the cash flows for that property versus where they were 2 years ago, it's a different story. You flat out are earning less cash flow today from this investment than you did 2 years ago. And as home prices continue to go up in the future, guess what, Pablo?
What you see?
This phenomenon is going to continue. It's likely to continue. This is one of the reasons why when you decide that you want to buy a turnkey rental property, you want to put this into your financial portfolio, that's usually the best time to invest. It's because over time, home prices tend to go up. Rents don't keep pace with home prices. And, there's some variability about what interest rates are going to do, but we still have very low interest rates compared to the historical interest rates. And so when that happens, you generally are setting yourself up for a future purchase that you might buy 1 year from now. It's probably going to have lower cash flows than it does today.
I mean, that makes a lot of sense. So, I mean, we've been seeing property after property, right? Like we've been gone from a period where you could put 20% down and maybe still make like $100 a month, right? To like now where it's more like 30% to maybe make 50 or 80, 25% to be right at break even. I think we got a pinch Mike coming in.
Okay.
Just, I think you're sounding a little bit low.
Okay.
Let us know. This is why we need the community. You tell us where
Look at
we're
this.
messing up.
Beautiful.
Talking to that thing.
How we doing? A little bit better?
Does it sound better? Let us know. Let us know in the chat. So, the monthly cash flow, continues to get squeezed. And what are we to take from that?
Well, this is something that we should understand how we're making decisions today and how we can better maximize our return on our investment. So that's something for us to understand for the future. But we also need to have context here, right? Just because cash flows are coming down, does that mean that this is a bad investment now? Right?
I mean, not the way that I've been taught this, right? Like you have taught me to see the cash flow as the entry to the dance, right? And like you have positioned the idea of different markets having different qualities. So if I am investing in Jacksonville, I am investing for growth. Whereas if I'm investing in like Montgomery, Alabama, I'm investing for cash flow and giving up the growth.
Yeah, there's a lot that goes into the right decision, for the right market. So there's cash flow, there's growth, right? That would be home price appreciation. But there's 5 profit centers as to why we're investing here. And I think what is happening now, and we have been talking about the 5 profit centers for a long time. And what I predicted a couple of years ago when we started to do the show is that if turnkey rental property companies were going to be successful, they were going to have to learn the 5 profit centers.
That's right.
They were going to have to become good at it. They were going to have to sell their properties based on it. And then guess what? If you look at evaluations from turnkey rental property providers from years and years and years ago, there was no mention of tax savings. There was no mention of principal pay down. There was no mention of home price appreciation. But now if you look at those property valuations, now people talk about that. This is becoming more of an understanding, more of a reason to invest. But the reality is that this was always the reason. The 5 profit centers were always the reason that this asset class did better than the stock market and better than most alternatives. So it's like, yeah, it seems like a new phenomenon here, but to me, it's like, listen, if you didn't understand that this was the reason why you were investing in rental properties back in the day, you were missing the big picture. So like now, because of the market dynamics, because cash flows are going down, we're all forced to understand the big picture. So I'm happy about it, right? This is why the 5 profit centers, not just one, not just cash flow, the 5 profit centers are the reason why this asset class is better than most alternatives out there.
So 5 profit centers, cash flow, which we like to call the entry to the dance, right? The closer it is, the more positive it is, the more scalable the investment becomes, right? Once it becomes cash flow positive on a monthly level, it means that you can add more and more without dipping into your own income as you are building this thing out long term. Then there's the debt pay down, right? The idea that your resident is paying down a mortgage that you took out. That's what Tim Hicks famously coined as like, worst comes to worst, somebody's paying off a loan for me, right? And building equity. Then there's tax savings. I just got to tap into that, right? I just finished my 2021 taxes right on time. I owe a little bit because I also cashed out a 30,000 stock gain.
Not much I can do there.
Not much you can do there, but it really totally lowered my tax base, right?
That's
Like,
awesome.
so yeah, it was really, really cool. So those tax savings that you're saving there is the inflation hedging, which is becoming more and more important right now in incredibly inflationary times. And then there is home price appreciation. The way that you have taught me, I think you have taught all of us here, the way that I conceptualize it is if I'm investing, the more short-term the window, the more I care about cash flow, the longer term the window, the more I care about home price appreciation, because that's the thing that really pays over time.
Mm-hmm.
Is that kind of it?
Well, you're throwing me for a little bit of a loop there. The short term, and the more I care about cash flow, the long term, more I care about home price appreciation. Tell me a little bit more about your thoughts there, because I want to make sure I'm.
Yeah, if I plan on living off of the cash flow that this thing is spitting out,
Yeah.
then I really care about cash flow,
Right.
right? Because I need to use it to pay for my cell phone bill or my, like my prescriptions or whatever is happening, right?
Mhm.
If I'm not really doing this in order to pay for things that I pay on a day-to-day basis, then what I really want is my money making money for me. And therefore, the longer the window until I need my money to make money, until I go from money making money for me to me living off of my investments, the more I care about home price appreciation.
I would frame this a little bit differently. So the short run, long run, if people are thinking about short run or long run and they're coming to rental property investing, I don't think this is built for the short run.
Okay.
Right. So this is not the right asset class for you. If you're trying to buy something today and you're trying to sell it in a year and you want to make a great risk adjusted return on investment. And, because real estate is an expensive thing to sell. And the reason that I say that is even if the market does go up in value, you still knock off roughly 10% of your sales price in selling, holding, and closing costs. So even if you have strong cash flows, and even if the house appreciates, you're still going to give so much back just because of what it costs to sell. So hold the property while it's selling, and then there's closing costs that it's not built for the short run, no matter what.
Okay.
Right. And I think that's a really important point, right? Like many people don't think about that. And what has happened over the past couple of years encourages people to come in for the short run too, because they think that you can get these incredible gains over the short run and that's normal, and it's not. So let me kind of separate that. Like short run investing, I don't think rental properties is the best thing for you.
Okay.
There's a lot of other things you can do.
And to be fair, we are also talking about financing a rental property, right? Like there's a big difference between buying a rental property cash and living off that cash flow versus putting down 30%, taking a mortgage out there, and then letting leverage do its thing, right?
That's the differentiator. So for somebody who is in rental property investing, you got to be committed to the long haul. If you want to earn the best risk-adjusted return on investment, you got to be committed to the long haul. However, if cash flow is really important to you because of your quality of life, meaning maybe you are nearing retirement and you need to replace active income and you want to do that through rental property investing, then it's more of a cash purchase, which is not using financing, or is this using financing? Cash purchase will get you immediate cash flow, right? You'll have better cash flow coming in than if you would if you were putting that in a bond or something, right? But if you use financing, you're going to get less cash flow. It's less than if you would put into a bond. It's still positive, but it's less cash flow, but your upside is so much higher. And so the need for cash flow to me really determines cash versus financing on the type of purchase.
And another differentiator that I want to say that Noah brought up, this is for investing in a rental property today.
Yes.
Versus tomorrow, right? If you own rental properties, cash flows are going up.
Yeah, thank you. I always want to make sure I specify that. And that's such an important point. When you already own the assets in your portfolio, you're in the driver's seat. You have a hard asset, especially the way that, macroeconomics are working right now, which is where there's significant rental demand expected for a long time. You should continue to see home rents go up. And so, yes, the cash flows you already have in your portfolio are in a great spot. I don't see those going down. In fact, I see those going up like you're talking about. I'm specifically talking about that investor who's like, should I buy right now? Or should I buy that same property a year from now? Buying that same property a year from now will actually get you most likely lower cash flows than you have right now.
Got it. So those of us that own, so basically the mechanics, right? Like what happens over time in a rental property is if you're financing it, for example, you finance it at an X payment that happens monthly, right? And you want to do that at a positive cash flow as much as you can. Over time, that debt starts to get paid down. So you are paying less of a mortgage. So your monthly cost of ownership goes down. At the same time, over time, the rent that comes in goes up in Jacksonville, at least, right? Because it is a growing population, rent continues to rise at an astronomical rate. So over time, whether or not if you finance it, it's going to do it. But even if you pay cash, over time, your cash flow goes up.
Let me help you a little bit.
Yeah.
All right. So you talked about so big picture, what you're talking about is correct. Like over time, once you have the asset and you have financing in place, rents generally go up and your cash flow, the amount that hits your bank account, does go up over time.
Mm-hmm.
But you broke it down into two components. You talked about rents going up, which I agree with, but you talked about your payment going down over time.
Mm-hmm.
All right. When your payment is locked in for the next 30 years, your payment is actually the same.
Oh, okay.
Yeah, this is a really cool thing to dig into. I don't know if we've actually broken this down for folks, but your payment stays the same. But as a part of your payment, the amount of principal that you're paying every single month is a bigger chunk as time goes on.
Got it.
So your principal pay down profit center improves, even though your cash flow does not necessarily change just from the change in your mortgage payment. Does that explain well?
Yeah, that makes sense. Does it make any difference if I'm taking the cash flow from the property and paying down the mortgage sooner? Does that bring down my payment at all, or it just accelerates the amount of equity that I'm building and the payment will always stay the same?
The payment will stay the same until you pay it off or you refinance that payment.
Got it.
So the compound cash flow effect, the C3X effect that we talk about, or the waterfall effect, that gets you closer and closer to paying one off completely. And then at that point, it frees up, call it $1,000 of cash flow. And then we use that $1,000 of cash flow for that rental property, plus all the other positive cash flow to attack the next one. But in the middle of that process, while you still have a loan on there, your loan balance is going down, but your payment still stays the same until it's paid off or refinanced.
Can we just sit on something we've never talked about?
Yeah.
That's cool. That's cool. All right. A couple of questions real quick. Raj Bantu asks, what is the current, oh, by the way, we're doing not your average insights, right? So if you guys, if the community's got stuff, bring it in, right? Because we're just kind of like riffing on concepts that we want to explain better. So Raj asked, what is the current months of inventory in Jacksonville right now?
I checked last month and it was 2.3 months of inventory. Still historically low.
Yeah, 2.3. So again, equilibrium about 6.
6 to 7 is equilibrium.
When COVID broke, it was like 3.
Well, when COVID broke, it was actually 2.5, if I remember correctly. It was higher than the most recent.
Than it is right now.
Yeah.
Right now it's 2.1, you said?
2.3.
I was way off.
It's a good thing I'm the numbers guy.
You are the numbers guy. Got it. So months of inventory means if it is below the equilibrium, higher than average appreciation rates. Ergo, at 6, it's like 4.6% historical appreciation rate. At 2.3, it's going to be higher than that in the short term.
It's an indication of where pricing is going to go over the next 6 to 12 months. It's a strong leading indicator for pricing. Now, you can't look at this in a vacuum though, right? Like months of inventory can change, right? If builders would be in a community and drop thousands of houses at one time, the communities would all finish in the same place and they would flood the market. That months of inventory number could, in theory, change dramatically. So you have to look at the velocity of changes, which we're monitoring. For anybody that's interested, it was 1 month of inventory, I think 4 months ago, somewhere around there. And now it has gone up to 2.3 months of inventory over the course of a couple of months or a few months there. And generally speaking, you would expect months of inventory to rise during the winter months. Even if we didn't have a lot of external factors like we're faced with right now, you would expect MOI to go up in the winter months because less people buy houses in the winter. So it's a great leading indicator, and I'm glad everybody in our community understands this and asks questions about it. We need to be talking more about it than just that number, because I don't want people just to say, well, 2.3 means it's going to go up 8% next year. That doesn't exactly work like that.
Got it. Okay, cool. And just to be clear, months of inventory, let's say it gets to 8, it doesn't mean that now appreciation is negative. It just means it'll be below 4.6% appreciation.
That's what it would indicate. There are many examples of months of inventory actually being higher than 7 and still having home price appreciation above the norm. So yes, to your point, it does not mean depreciation once you go over 7. You got to look at the total package and have more perspective, which I'll continue to keep you guys updated on.
We will continue to talk MOI. I feel like we put MOI on them. I feel like you put MOI on the map, by the way.
I think we should get tattoos, MOI tattoos.
How will people know it's not French? Moi?
We'll fit in when we go to France and take the show on the road.
Oui. All right. I can't wait to meet Anonymous. All right. So Lee Bishop has a question. Can you touch on the home market, the home market in Jacksonville, like inventory and rent increases and home price appreciation rate versus the national average?
I can. So I guess we'll kind of start right now, right? So nationally, months of inventory is a little bit higher than what we have in Jacksonville. I should probably start off by saying, comparing this to the nation, it almost doesn't do a lot of good, right? There's not one national real estate market, right? To really have actionable information here, I think you compare it to what your market is in your area and whatnot. But I just happen to know there's the national stats just to share with you. So our months of inventory, call it roughly around 2.3 or 2.5, right around there, is below what the national months of inventory is. Last I checked, it was between 3 and 4. And the other questions, home price appreciation. Our home price appreciation is definitely on the high side over the last 2 years, largely driven by population in migration, so population growth here in Jacksonville. And so our home price appreciation over the last 2 years has been between 15 to 25% per year. Rents have gone up at a faster rate here in Jacksonville than they have in other places in the country as well. Same dynamics here, limited supply of housing and huge population growth, and also pulling forward demand on the home pricing side because of those low interest rates. People that were potentially thinking about buying a new home, they bought because they could get an interest rate in the 3s for a long time. But we're higher on rents, we're higher on home prices, we're much higher on population growth, which supports that. And we are below the national average for months of inventory currently.
To clear things up, we are higher on rent growth, higher on price growth.
Thank you.
Right.
I'm glad you're the numbers guy.
Yeah. No, I'm the make it make sense guy. It was rent. You said price, and you're like higher than average price, higher than average rent, which is not the case, right? Like it's just higher than average growth, and lower than average MOI, meaning we have faster growing numbers that are attractive to investors, right? As in like if you buy something, your house is going to be worth more tomorrow here versus the average Anytown, USA. If you are moving into a home here in Jacksonville, next year, your rent is probably going to go up higher than average Anytown, USA. And the months of inventory, AKA the supply of homes in relation to the demand of homes, is lower than most places, meaning that these numbers will continue to grow at a more rapid rate than other places in the U.S.
I think we need to monitor it, right? I'm largely looking at current data and past looking data. When I talk about the rent price growth and the home price growth, I mean, I'm looking at for the last year and 2 years. And then MOI, I'm quoting like right now. But we've also had more building here than in most places in the country as well.
That's true.
And so, I think we need to see how this all pans out. I don't know if we're going to be one of the fastest growing rent price markets or one of the fastest growing home price markets next year or the next year. I would caution us. I don't really think it matters either way, right?
Why doesn't it matter either way?
Well, I just think short-term pricing is the least most important part.
You're talking about year over year. You're not concerned about it. You are less concerned with that as opposed to, hey man, over 30 years, I know what's going to happen.
Over 30 years, I know we're going to get, call it 4.5% annualized home price appreciation. And so if you're buying a house today, I don't think it really matters if your rents go up 4.7% or 5.1% next year. Over time, they're going to go up about 3.5% a year.
Rents?
Rents, yeah.
Okay.
Over
Even
time.
though right now they're going up like 10, 20.
They did. So next year, according to John Burns Real Estate Consulting, he's expecting 4.7% rent growth for the Jacksonville market.
Okay.
Which is significantly more than the historical average. The
Okay.
historical average is 3.3% rent growth per year for the Jacksonville market. And
Got it.
So
Cool. Awesome. These are fun numbers, man. All right. So let's talk about a couple pet peeves around cash flow. I don't know if pet peeves. I think things that we want to shine a light on.
Okay.
Right. You like to rail against the idea that people are just obsessed with this cash flow number.
Yeah.
Why does that really yank your crank, GC?
Well, when I think about why it yanks my crank, I just think that there's a double standard here. And I constantly am just bombarded with, just examples of this double standard. I just sent something out on our Facebook group talking about how there was a recent study done based on stock fund managers. And what they uncovered is that something I had never thought of, but, in a stock prospectus and a fund portfolio prospectus, you show your performance of your fund versus something that, you're comparing it to, a section of the market that you're comparing it to. And so this study was done, and it showed that 30% of fund managers, when they were underperforming, they didn't continue to show their underperformance in their prospectus. They just changed the section of the market that they were comparing it to. And this is totally legal. And so I'm like, maybe I'm jaded, right? But I just see so many things that are done largely in the stock market world, in stocks and bonds, that are accepted, and people are encouraged to invest, knowing these things, and they're just like swept under the rug, or it's just not a big deal. But then there's one little thing in rental properties, and people are like, oh, well, hey, no, I'm definitely not. You'd be crazy to invest in rental properties. You think I'm going to do that? No way. No, I'm going to go put it in the stock market, where fund managers change the rules all the time. And, cash flow is one of the biggest gripes that I hear about why you shouldn't be investing in rental properties. And the first question I ask people is, are you getting cash flow in the stock market? Like, talk to me about the cash flow you're getting in the stock market, right? Almost no stocks provide dividends. There are some that provide dividends, which is the same as positive cash flow or net rental income. But I tell you what, they are not getting rich based on the dividends that they might get. They might be 1% dividends or 2% dividends. Like, it's not helping them reach their financial goals, even if they get a dividend, which is really, really rare. And so I'm just kind of tired of everybody saying, listen, I'm not going to invest in rental properties because of this reason. And I'm not tired because it might be a valid reason. I love those conversations, but I'm tired if that's the same reason that they then say that the stock market is better, then they go and put their money in the stock market, because I think ultimately they're losing. I think that as a nation, we are way over invested in the stock market. We lack diversification. And at the end of the day, if you invest in rental properties, it's proven cycle after cycle that it performs better than the stock market. If you understand how to use smart debt, it performs better than the stock market, and it has less risk. I mean, we just went through the pandemic. When the pandemic hit in March of 2020, the stock market dropped 30% like in a week. It really hurt people. People were freaked out. For that, ever since the pandemic hit, we have collected 97, 98% of rents and rental properties. And it's not just because I love my team here at JWB. I'm also talking about rental properties as an asset class, as an investing space. We have performed very consistently. So I think it's a lower risk, and I think that it is better returns. And I'm just tired of all the excuses that people don't hold the stock market accountable to. And there you go. That's what yanks my crank.
This man's crank has been yanked. Yeah, it's interesting to think about it, right? Like, as I've had my discussions with my wife and being in this asset class and going on the journey, and like having the short-term pains of like a bill here and a bill there and whatnot.
Right.
It does strike me that, right? So I have to assume that the majority of America is just in their 401k and the IRA, and they just don't even think about it, right?
Right.
Like, it's just like, put it in the stock market. To your point, they're not there for the cash in the stock market. They're there for the appreciation.
Right.
They're there for the growth of the market, aka the appreciation of the price of the stock, which is 1-to-1 appreciation of the home value, right?
Exactly.
And then there's like another bucket, right? So there's like what you do in your IRA, that's pre-tax, whatever. If your employer doesn't allow you to put that in real estate, cool. But then there's a whole nother bucket of, that you are investing outside of just your own, you get a bonus and,
Right.
different things, or you hit sales quota, or, whatever, you're dutifully putting this stuff away. Those people are, maybe some of it's dividend stock, but like you said, right? Like, they're betting on appreciation too. Like, they are there for the appreciation of it, not the short-term cash flow, not the whatever. And they're not there for like appreciation because it's always going to appreciate. They're there for appreciation that drops 20% and then goes up 15% and then drops 5% and then goes up 20% and then whatever. And they're hoping, they're like, well, in time, it's going to be like 8 to 9%, right? Like, that's what people are betting for.
Yeah, but what does that mean? They're saying like over a cycle, it's gonna work out, which is exactly what I preach here for rental property investing.
Yeah.
Over a cycle, it's gonna work out, except when I say work out, it's better returns and lower volatility. It's better returns and lower risk, right?
Is there anything to the fact that you're spoiled because you run a world-class property management company, so it is lower risk? Like, you just mentioned the asset class in general, right? Like, how much does it have to do with like the fact that you as a company have really figured out the asset class as a management experience?
It's a good point. It has everything to do with that. So when I'm on my soapbox here ranting and raving, I am assuming that you have found a company like JWB, because if you are investing in rental properties on your own, then I don't think that this applies. There is more risk to do that. And you might not make it the full 10 years or 20 years of owning that rental property to see all 5 profit centers. And you might not be helped along the way to understand how to use smart debt to your advantage. So it's a really good point, and I should probably qualify that. That is when you're working with a vertically integrated company like JWB, who has nailed down property management. That is absolutely true.
Yeah. So then that's why people do it. People run from it because they haven't identified a good operator. Like, they haven't been educated that the key to success is an operator, and they haven't been educated on the idea that you find an operator by seeing somebody that is an investor who is investing right next to you, is thinking long-term, is planning for long-term leases, reducing turnover, as opposed to making money from the property management company, maximizing profit from property management as much as maximizing return.
Yeah. No, you said it well.
Okay, cool. All right. So we got that figured out. I heard there's something else that takes the jelly out of your donut, Greg.
Yes.
And it is,
That's just what I was thinking.
and it has to do with the mentality of people work really, really hard to get to retirement and save something, and all of a sudden it's not there for them.
Yeah.
Tell me more about that.
Well, I just believe that, cash flow is important right now, but what's more important is those goals that you have and that lifestyle that you want to live in 10 years or in 20 years. That cash flow at that time is what we really should be talking about. Because cash flow, when I buy a rental property today, I need it to be positive, but whether that is $25 a month of positive cash flow or $50 a month of positive cash flow, or even $100 or whatever number, it's not really going to change my quality of life today. It's not going to change yours. It's not going to change yours out there. Yet so many people say, well, listen, I'm going to choose this team or this market just because I'm able to get $25 a month more in cash flow. Like that doesn't make sense to me. What I think we should really be talking about is in 10 years, when cash flow really matters, or 20 years, if you're starting earlier, when cash flow really matters, that's really what's going to affect your quality of life. And your loans can be paid off or very close to being paid off your portfolio by that time. If you work with an experienced team who knows what that looks like and who has lived that, and that's what can really change your life. And so nobody really talks about the cash flows in 10 years. or 20 years. I think you've done a great job of talking more about that on the show than even I was doing back in the day. But I think about examples like your dad.
Yeah, we call this the Humberto Gonzalez fallacy.
The old Humberto, I think we're going to call it.
The old Humberto. Yeah, man.
Talk about that.
Yeah, I've just that has been, living through it, right? My dad, successful all his life, right? Like has never had a problem with investing, has generated cash flows, has enough to retire comfortably, right? After living comfortably. What I have seen in the last 6 months is behavior from him that I've never seen, right? It is oh yeah, man, not this month. Cause, yeah, we want to do this, but I'm not going to do it this month because stock market just did X, Y, Z. And it really struck me as odd because we've never lived that way, right? Like full disclosure, successful person. My mom spends whatever she wants and gives a lot of gifts to people, right? Like she's the best.
Yeah.
I've never seen him been so, has always been dutiful about like saving and spending and spending less than he earns. But I've just never seen him so dutiful on like cutting back on certain things, like a trip here or a trip there for whatever reason. And I know that he's really risk averse. I know that he's not really in a problem, but like that psychological pressure that he's going through based on he had this number that he had thought of his whole life to be there for him. And all of a sudden, when he gets to that moment that the stock market just took a 30% dive, seems extremely unfair.
I agree.
And I can't, when I think about it, I can't imagine if we don't know what short-term stuff is doing now. Like, I think that when we're all headed towards retirement, and the human race is headed towards living longer and longer. Like I still don't think that we figured out this idea that like, we complain about maybe retirement age needs to go up to 68 or 70 or whatever, but we haven't thought about the fact that like, yes, because we're likely going to live into our 90s. And therefore it's not that you have to retire sooner. It's that you need to save more money.
Yeah.
Because if you're going to tack another 5 years of living expenses, you're going to need that money.
Yeah.
Right. So the idea that we're going to go into retirement and likely live another market cycle in retirement, what does that do for the monthly quality of life that I'm going to have when I'm in that moment? If I'm betting on a volatile thing that can go up or down and reduce my cash flow by that much, if I have $5 million in the stock market and I'm living off of it, versus if I have 20 rental properties and I'm living off of that rent, and maybe one or two is vacant at that time, but I know for sure that I'm going to have like this much every single month.
Yeah.
Just never been more obvious to me.
Yeah, man. It's thank you for sharing that, by the way. I think that's an example that touches all of us here, because either we are in that scenario or we know somebody in that scenario. I've had a similar conversation with my dad, who retired, semi-retired early, and is with inflation right now too. I mean, tack that on there, like the cost of things when you are on call it a fixed income, right? Fixed income could be whatever the income source is, but if you don't have active income, right, you might be living off your investments or whatever, Social Security. Inflation really hurts folks that are on a fixed income. And, what I think is like, instead of, I wish we all could change this mentality of like, I need to get to this number, like this idea that like retirement is about getting to a number and then you can retire. It just doesn't hold any water now when we are experiencing the downside to the stock market. That number could be cut by 33% overnight.
Yeah.
We have seen that in the last couple of years.
Yeah.
It's been close to that as far as drops in the stock market. I wish people would think about like this as like, I always thought of rental properties as this army of income producing assets. And I cared very little about what number my net worth was or what number of capital I had at that moment. When I was 23 and 24 and I was starting this portfolio, I was just like, let me get as many of these assets in this portfolio that are paying for themselves, and my loans are getting paid down by my residents. And I know that I'm going to be in control of my time, and my quality of life is going to be protected 10 years, 20 years down the road. And like, I wish as an economy, we could buy into that.
Yeah.
Right. Rental properties is one way to do it. You get the asset. The resident pays the loan down for you, and you're left with this asset that people are going to continue to pay you a lot of money each month to live in your home, right? If it's not rental properties for you, find something else like that, but don't just like buy into this fallacy of like trying to hit this number, because what happens is, you know what happens? It takes you your entire life to get to that number. And then when you get to that number, it's all based on this. It's not based on income. It's based on this number. And you get there, you have this big pile of money, but guess what? You're in this part of life where you need to be conservative. And so you then transfer that number into income, but because you need to be conservative and you don't have time on your side, you can't, right? You don't get all the benefits that you did if you had started in rental properties early. So what do? You put it in super conservative, low yield bonds or other type of assets. And so you've kind of like hurt yourself both ways. You spent all of those years where all 5 profit centers could have been paying your loans down for you, and you built up this number. And then when you get there, you're largely going to invest in things that provide a very low of monthly income to you. And so it's like a double whammy. It's just not right. You know, it's not right that people are educated this way, that is the only way to do it, is my opinion.
That's another thing I've never considered until right now that you said it, but like, not only you're taught to save up to this number, and you don't know what fluctuations are going to affect the size of that number when you're there, but you also don't know, you're going to have to take that number and put it into bonds and whatever things that are guaranteed. You don't know what rate that's going to be at when you're there either.
You don't know, but you can pretty much be assured that it's going to be a lot lower than what your yield would be on a fully paid off rental property.
Yeah. Yeah, totally.
Right?
Yeah, totally. All right, that makes a lot of sense. All right, man. So last thing that I want to talk about that just puts a turd in your swimming pool is the
I'm glad this only goes out to,
nobody wants to swim there, Greg. Is the misconception kind of like over time, right? Like if we can debunk these ideas and explain the idea of the ROI based on appreciation, how people kind of like mess that up. I would love for you to talk through that.
Yeah, so we, as a general statement here, real estate investors or others who may be thinking about investing spend so much time talking about cash flow, and I'm not going to invest if it doesn't hit this cash flow requirement. It must be a $50 a month cash flow, and all this time spent on cash flow. When you look over, for somebody who, like me, I manage over $750 million real estate portfolios. People have been investing for 17 years now with me. I've had the beautiful experience of seeing how their returns have actually worked after a full market cycle. And when you look at how their overall portfolio returns work out, cash flow is about the lowest contributor of their return on investment. And so it really makes no sense to me why we spend so much time saying, geez, rental properties, I can't count on cash flow. The cash flows aren't high enough. I'm not going to do that. I'm going to go put my money in the stock market. Listen, I'm not going to invest in Jacksonville because I can get $25 a month more by investing in Sheboygan or wherever. And then at the end of the day, when you look at how your money performs for you over a 10 or a 20-year cycle, cash flow is like this much of the overall profit pie. So it's like much ado about nothing, in my opinion, right? I don't want to say that I don't think cash flow is important. I think cash flow is incredibly important to make sure that it's positive. But beyond that, the marginal benefit of every $10, $20, $50 of cash flow really doesn't move the needle when I look at your overall portfolio after 10 years or 20 years.
Yep. So, I mean, we've gone over this through, I'm having fun in the chat because I've been setting you up for that swimming pool reference from Caddyshack. David Blattner got it, by the way. I was totally referencing the Baby Ruth scene from Caddyshack. And that's what I was going for. But
well done. Madison's over there like, I can't believe that I'm a part of this.
Yeah, Marilyn's saying that she's shaking her head many, many times here. So, we reference this when we do the guest investor segments, right? Mm-hmm. Like we look at the pie, right? This Skelton Road over here. Is this yours? Or is this
yeah.
Was this your original 2006 home?
Yep, I bought this in 2007 at the height of the real estate market before it subsequently dropped in value.
Yeah.
And I've continued to hold on to this thing. I still own it today. It's a beautiful rental property, rent it out, all that good stuff.
Yeah.
So,
And and when we're referencing this, right? Because as I've been going on shows to represent JWB, I've been talking about this like IRR and ROI, and I've been talking about all these numbers. But you told me something like these early ones, right? Like as tomorrow, cash flow will be less than today, right? And you bought this 14 years ago. So you bought this at like sick cash flow to begin with, right? Like you could sell it based on cash flow back then.
Yep.
And yet, having bought it with the peak condition of cash flow, you got this little Trivial Pursuit slice.
Yeah.
But still, the majority of this thing has been home price appreciation. When you look at it, if you're listening on the podcast, it's 2/3 home price appreciation, maybe like a quarter cash flow, and then a quarter tax savings plus principal paid down.
Yep. And this was from 2007 to 2022, right? So our home price appreciation percentage is lower than the historical average, which means that you would see a lower part of this slice being home price appreciation because of this.
That's right.
But it's still 62.5% of my overall profit pie here.
Yeah. So during super high cash flow, lower than usual home price appreciation, still 62% of the pie, and cash flow is only 20% of the pie. And then if we extrapolate that to more recent clients that didn't buy at the worst time to ever buy. Good job on that one, GC. We look at 2007, and we're looking at a bunch of different pies if you're listening on the podcast, but still every one of them from 2007 looks kind of similar, maybe a little bit more than 2/3. If you bought in 2012, it's getting into like the 3/4 range. If you bought 2012 to 2016 is getting into like the 3/4 range. And like 2019, you're seeing just like it's a true Pac-Man, right? Like it's just the little mouth of the Pac-Man is everything else, and the rest is home price appreciation.
Yeah. So why are we so focused on cash flow being maximized? Like, shouldn't we be focused on all 5 profit centers? And if we're focusing on one profit center, why aren't we focusing on growth? Like, this is how your portfolio is going to look after you hold on to your rental property for 10 or 20 years. It's going to look like that no matter which market you're in, by the way, assuming you get home price appreciation in your market, right? You do over 10 or 20 years in most markets. But like, there's a big difference between another market and a growth market like Jacksonville, because while your percentage of your pie is still going to show that home price appreciation is the largest percentage, your potential of what your growth can be in a market that grows at a faster rate, it's worth like hundreds of thousands of dollars on every single property. Yet inexperienced investors and savvy investors spend so much time and they say, listen, I'm going to write off the Jacksonville market because listen, cash flows are only $25 a month. I'm going to go to Sheboygan where it's 50. Like, it just doesn't make any sense.
Great question by Miguel Angel Sanudo. Does that mean that this is turning into a buying and selling business? Like, why are we so focused on this home price appreciation thing?
Is this turning into a buying and selling business?
Yeah, like, is it are we focused on home price appreciation because you're planning on selling the home? Like, or what's the play here on home price appreciation? How does that help me get returns?
Yeah, so there's a number of ways that you can get returns when you get home price appreciation. That doesn't mean that you need to sell. I mean, you can see me, I still own that property today. I have no plans of selling that property. But my job is to deliver the best risk-adjusted returns for you. So just like a stock that you have, if there's a stock that has a ton of appreciation in the stock and your overall strategy is to hold, just because you have appreciation in that stock doesn't necessarily mean that you sell the stock, right? Same thing with your rental property portfolio. You want to get a lot of home price appreciation. Just because you have it doesn't mean you necessarily need to sell, right? So like, for example, if you have a lot of home price appreciation in your rental property portfolio, you can do a refinance. You can pull out equity from that purchase and, you could live on that equity, right? You could live on that equity. Like, for example, for somebody who bought homes and they did it when they were young, and by the time that they're 60, right now, they've got those properties fully paid off and they wanted to go and spend some money on something, take a big trip or something, they could pull some money out of that property. They don't pay any taxes on that, by the way. because you haven't realized the sale yet. And there are many folks that continue to just live their lives by doing that. And then the loans get paid off by that resident again. So there's a lot of ways that you can maximize your returns on investment by having home price appreciation. You can sell, you can refinance, you can do fun things like a 1031 exchange. But the key is we got to get all 5 profit centers to the maximum level as they can. And my point for bringing up cash flow versus returns here is just because you just shouldn't discount a market, in my opinion, because it doesn't meet maximum cash flow. I think we should all look at all 5 profit centers together.
Yeah, love that. So I like this illustration here at the end. It's if you have like, if I'm 65 and I end up with like 10 homes that I own outright, I am able to take out equity, right? Like I can like refinance the home and now I got some cash flow. Now I got a bunch of like cash in my pocket. That is still going to be cheaper cash flow than rent, right? Like the rent is going to be able to pay off that debt and I can use that cash to go, like live off of. I can use that cash to invest in other things. I can buy more homes.
You can send your grandkids to college.
You can send your grandkids to college. Like you can pay for college. You can pay for other homes that get you more cash flow, that get you more rent and whatnot, right? So like having the equity in the home is what Jim Kirko is saying here. He's saying equity is the answer. It allows you choices, right? So, and you could sell as well.
Exactly. And I mean, you probably don't need to do any of those unless there's a big opportunity for you or a big thing you want to do for your grandkids and send them to college or something. Because if you have 20 homes that are fully paid off, you're netting like 20 grand a month in today's dollars, in like 10 years, 20 years, 30 years, it's going to be more. Mm-hmm. Cost of living will also go up by that point, but you're probably good either way.
Yeah. Or you could be like, so Miguel Angel's asking, so this is only thinking in your retirement as cash flow is diminishing, especially if you buy cash. Like what I think of when I think of this is Ken and Carolyn Moline, right? Like Ken and Carolyn Moline living in San Jose, California, right? Silicon Valley, somewhere close to there, one of the sands, in NorCal, take a reverse mortgage on their home because it's greatly appreciated in the California market. They can then go buy a bunch of properties in the Florida market outright that produce a certain amount of cash flow. So like, let's say you're doing this in Jacksonville and you're buying right now because Jacksonville is this place that is still undervalued. It's still growing. In 40 years, who knows? Maybe it's Newport Beach, California. That's
Sure.
My bet, right? And it is no longer that. But if you were able to refinance homes from there, you can then go buy, I don't know, cash flowing property in Belize. You can buy cash flowing property in Montgomery, Alabama. You can invest in a commercial syndication like Zach Correa has done in a Nashville, something like that. You can go buy a racehorse, like whatever you want, right? Like you can just take that cash and invest it in other things that produce other cash flow things.
You're in the driver's seat.
Yeah, you're in the driver's seat.
I think, who was it that said that? Gives you options. Jim Kirko.
Kirko.
Finer words never spoken. Equity allows you to have choices.
Jim Kirko's a great name. Sounds like a Hall of Fame pitcher or something like that.
Great.
I'm into it. All right. Great show, GC.
That's fun, man.
Yeah, this is a good one, buddy. We've been wanting to just like rant on this stuff. We love these Not Your Average Market Insights shows because it allows. He is a Hall of Fame pitcher. I knew it.
Love it. Is that weird?
I'm not surprised. I don't know. It
Jim,
does.
Are you serious? I feel like I know your name.
Like I feel like I had your baseball card, Jim.
Yeah, I know.
So great show, man. I love these Not Your Average Insights because we just get to kind of shoot from the hip, and I get to use analogies that are going to make you uncomfortable.
Oh my goodness.
And do all these different things. Next on Thursday, we're doing something else that is kind of uncomfortable. We get to do it in front of a live audience again, right? Like once a month, we're going to do the Property of the Week show. We do it in front of the team. We move the studio in front of the team. Live audience is going to be a lot of fun. Hope you join us as we do the JJB. We're doing a Property of the Week. And yeah, man, I'm just super grateful that we had 40 plus people that hang out with us on a Tuesday. Like this is so great. Like the fact that you take time out of your day to pitch in some great questions, Jim Kirko style, and be part of the conversation and just kind of continue to show up and make jokes in the chat and be friends with each other. It's just the absolute best. So I just want to thank you, GC.
Thank you, brother. I mean,
Yeah.
this is came to be because of our community, came to be because of you. I know you pitched me on the idea. You're like, hey, listen, let's just show up and talk. And I'm like, immediately, I'm like, oh no, I'm not prepared on all this stuff. But it's one of those beautiful things where we show up, we get to just go on and on and on. And I think you all out there are enjoying it more and more and more. There's better questions, there's more chat, there's just more insights, I think. And quite honestly, too, it's less work for me to do too. So I think it's a win all the way around. We just get to show up and be ourselves. So thank you all for making this possible.
I'm super pumped that Jim has officially got a nickname, Hall of Fame pitcher Jim Kirko. Every time you show up, Jim, we're talking to you. So if you want to be a Hall of Fame investor like Jim Kirko, there's just no chance you can be average.